Good morning all, and welcome to our 9th In the Room webinar. As always, it's great to have you here, and we really do appreciate your time, and we value that, and thanks very much for joining us. My name's Steve Backhouse, and I'm the host of the Innate in the Room webinar series. And today I'm joined by Nick Balkin from Foord Asset Management. And Nick. Well, so first of all, welcome, Nick. It's great to have you here. Nick is the portfolio manager of the Foord Balance Fund, Foord Conservative Fund, and Foord Equity Fund. And today, Nick and I will be chatting about how to take a forward-looking approach when it comes to making investment decisions, with particular focus on risk management. We really look forward to that. As always, before we kick off, a couple of house rules. So I think if you've attended these before, you know they are a interactive session. So it's really Nick and I having a chat around the topic, but we also really do encourage questions from the audience, and we'll definitely bring those in. What we'll do, probably Nick and I'll probably chat for 20-25 minutes, and then we'll kind of have a half time or a pause. And then start bringing in some of the questions from the audience. So look forward to those coming through. There is a CPD point available for the webinar that will go out in the thank you mailer after the webinar. If you attend, it's about 90% of the webinar, then the certificate literally comes in the thank you mailer. If for whatever reason you have to drop off early or you sign in late, for whatever reason, then there's a short kind of a little Q&A assessment that you can complete to get your CPD certificate. Otherwise, I think that's it from the housekeeping stuff. Only thing is on the questions, please use the Q&A tab. Okay, cool. So then then kicking off, Nick, maybe tell the audience a little bit about yourself, if you don't mind, to break the ice.
Cool. It's nice to know I'm your 9th favorite asset manager. I'm a pretty normal sort of dude. I think there's this fairy tale about these outrageous asset managers. I'm just a normal guy. I get home, my wife screams at me like everyone else. I have 3 kids. One of them sleeps, so I'm just a regular sort of dude. The one thing that I guess differentiates me is I just absolutely love investments. It's a standard thing that you get at Foord. You've got to love investments because it's not just a job, it's a kind of, it's your whole life. So interestingly enough, that just leads me to a kind of thought that I have when we interview people. Every single person has to be interviewed at Foord by the whole team before they get appointed, and then we send people for psychometric tests also just to understand that side of it. But I think one of the key things we're looking for is that passion, because at 10 o'clock at night when you need to do something, you need that person to really just love what they're doing. So I think that's who I am. I'm a guy who just loves to try and work out where the world's going and try and piece it together.
No, lovely. Yeah, I think we had a chat yesterday, and what we spoke about is often there's a I don't know, the portfolio manager was put on a pedestal, and actually, as you say, you know people got your own issues at home, kids not sleeping, etc. But you love what you do, which I think's great. Okay, then to get into the kind of the topic at hand. So we spoke yesterday again that you've kind of got, I think, 5 pillars of how or principles that you use in your investment approach. And what you spoke about was kind of, that's really helped you get through, I think the analogy was the smoke of COVID. And I quite like that term, the smoke of COVID, because again, you look at COVID's been stressful for everyone, but there's also a lot of noise around COVID. So can we, I think let's talk about those those 5 pillars, if you don't mind.
Yeah. So it's an interesting thing. I think so. The pillars weren't something that we've had for like 10 years. We're trying to. The key thing that what happens in life is you have a situation and you're trying to build a framework in some form to deal with some sort of uncertainty. And that those pillars were a way for us to think clearly, as you mentioned. The markets tend to, have a certain way about them, but then when there's some uncertainty or something extraordinary, we build a framework to understand clearly where the world is going with or without it. And it's a guiding light for us to, I guess, understand companies, understand different asset classes. And it's just a way for us, as you say, to block out how we're feeling today. Someone's sick, we see that the restaurants are empty, we see that life could quite change dramatically. And then we've got to say to ourselves what changed and what didn't change. And I think knowing what we know and ignoring the stuff we don't know is quite key. And this 5 pillars kind of helped us understand that.
So that's what it is. So give us so what is the first pillar? I mean, you mentioned something about dinosaurs.
Exactly. I think the key is everyone knows what happened to the dinosaurs, right? So there are 5 pillars, and if you want to go one by one, if you want to talk about all 5, we can go for it. But let's start with the first one.
Let's go one by one, and we can, hopefully really get into them so the guys and the audience can have a great understanding of these 5 pillars.
Okay, cool. I think, as you know, the dinosaurs obviously lived and then suddenly disappeared. And I think one of the key things for us as a house is we're forward looking, right? We're trying to understand, obviously looking at the past to see what happened, but also looking to the future to see where the world is going. And we've always had this view that probably the companies and industries that have the most headwinds are the easiest to recognize. And that we call simply the dinosaurs. It's an industry or company that will have long-term headwinds. And in the short term, sometimes people forget about those headwinds and the share prices can double and double and double. And then the typical investment guy will have more career risk and he'll say, I can't be out of that stock because it can double. And therefore participates in it knowing that probably that industry won't be there in probably 10 or 15 years, but doesn't really care either. So I think this first pillar is understanding that thematically avoiding a dinosaur industry, which is an industry that we think will have huge headwinds in time, is a huge generator of alpha. And that fits with our kind of thinking of risk not being volatility. Risk is actually the risk of a permanent loss of capital. And that, you see, so everything in the pillars should draw to our philosophy. And I think there are many examples around these dinosaur industries. One of them, very simply is the one we're sitting in right now. I'm at the office, but I guess most of you are at home, doing work from home. For us, the office market before COVID was a dinosaur industry, meaning there are too many square meters per person being used for office space. And through time, we thought that was going to come down substantially. So just recognizing that and understanding that COVID's an accelerator of that dinosaur industry allows us to say, no matter how cheap optically some of these office REITs look, it's easier to avoid them and look somewhere else for an opportunity. You can use the paper industry as something very similar. I use the paper industry as a great example because it's quite predictable. The decline rate's around 2% per annum on paper. We're all using less paper through time. There'll be spikes when the paper price goes up and a share like Sappi looks very cheap and people say, should we buy it? You can only buy it if you know when to sell it again, where we like to have a holding period forever. So I think if you're putting those philosophical thoughts together, understanding downside being a key risk, understanding our long-term nature, buy and hold good companies if we can, avoiding those kind of loser I actually don't like using it, but dinosaur industries is an alpha generator. People always think on the positive side, what about the great company you can buy? You got to think about what about the company that's going to not do well for 10 years to avoid also.
Yeah. So going back to that office example, so what I was saying is that it's basically you avoid property stocks that are heavily weighted in office. That's the type of and then obviously, as you said, I mean, is it that you actually saw pre-COVID, and COVID has just actually accelerated that?
Yeah, I'm going to cough a few times. Sorry, it's not COVID, you know. But
not.
Yeah, but so absolutely, I think what we need to do in that situation is two things. So firstly, exactly, we avoided them in the REIT space. We were actually in none of the generalist or office. So we were actually cautious on retail and office prior to COVID. We focused on companies we knew and understood, meaning a storage business. We're one of the biggest shareholders in storage. It's just a simple business run by two brothers that we really understand. They're great guys, they're founders. And all it does is storage, and actually been very resilient in the kind of COVID period, I guess, because of the business model. So, yeah, as I said, it is quite an interesting debate, and like with most things in investments, it's nuanced. I'll give you a direct answer, but it's very nuanced. Like offices, it's important to understand the decline rate, right? So in tobacco, there's a decline rate, but there's also a new product coming up, which is vaping, which could have a terminal value. And in office space, it would be important to understand where the decline in office goes to and plateaus before you kind of get to a bottom, because it's not going to go to zero. You know, there will be a requirement for office. So it's understanding that decline rate of an industry, where it gets to, and then the valuation that you pay for that industry.
Yeah, no, okay, cool. Okay, then let's get into the next one, which is you ride the circular trends. So
absolutely. Now listen, so once again, going back to the philosophically, when we look forward, the best way to buy anything is to find secular growth themes, right? And that could mean you could almost think about it just very generally from a macro perspective. You want to buy countries that are growing. You want to buy industries that are growing, and then you want to buy companies within those industries that are growing. Because, you know, I always draw from personal experience. My father was in recruitment, or is in recruitment still. He worked hell of a hard and still works hard in his 70s to this day. But no matter how many hours he puts into recruitment, it's a very tough industry, right? Sometimes when you're in an industry that with secular headwinds, which is the first one, no matter what you do, you struggle. On this case, the secular growth companies, these companies are almost the opposite. You can actually almost be an average guy and the kind of tide is taking you. So, you know, finding these companies that are in these big thematic trends that you can kind of ride, but then differentiating and picking the best company, the best management, etc., is a great way to generate long-term value. And
in some examples.
Yeah, absolutely. So in this thinking, I mean, everyone knows the internet, everyone knows the trend, and it's something that we as a long-term house really did believe in, I guess, for a long time also, right? So COVID, in all of these cases, are going to be an accelerator of a current trend that was already happening. So the first one accelerates down, the second one, it's accelerating up. And the e-commerce market has gone up from 15 to 16%, or whatever the exact number is in the US, and it's topped an additional 2% penetration as a percentage of total retail sales. The key there is that 15 is going to end up at 30% in the future. The Chinese are already up at those kind of levels. So we had our thoughts, when you think about it, of these big thematic trends like the internet and that sort of thing. I could use another example, like financial products in China is a great example, right? So we know that, as a percentage of penetration, our insurance market is quite well penetrated among, I guess, the employed market in South Africa. In China, it's the opposite. The people that are wealthy never had a safety net. So understanding that there's a 10-year cycle of financial products growing in China is a big thematic trend, and that will happen with or without COVID. So a company like AIA, which sells products across Asia, is a way to play that kind of trend. I'm just going to have a little sip of my thing.
That's fun. Yeah, that's good. Yeah.
And then I think the key is in that internet side of things, finding those companies that are well positioned there. So I use the example, and we've spoken about it before. We aren't really in these big global go-go stocks. The only one we own is, I guess, Alphabet or Google, which is, I would say, the value tech stock in a way. We've done a lot of work on, interestingly enough, there's a lot of talk right now about the monopolies of these tech companies and what happens. And the work we've done is actually Google is probably worth more split up than it is as one, interestingly enough, because of the, you'll start recognizing the value of Android, you'll start recognizing the value of YouTube, the parts actually will be highlighted much more clearly. So just as an aside. So I think that the key is to find the companies that you think are best positioned. And, we've positioned ourselves, we're not an Asian fund, but we do think that, I guess, in line with that kind of AIA comment, the penetration and I guess for many years, I guess being scared of investing in China created a valuation opportunity for those that recognized that China was the growth market. And everyone's saying China's growing, used to be growing 7 to 8%, and now it's going to grow 4 to 5 or there and thereabouts as a problem. But it's still the fastest growing economy in the developed world, once again, that we can latch onto from a secular perspective. So JD is a great one to play there. Sorry.
Yeah. Just make sure I understand it correctly. So basically on this kind of secular trend stuff, it's as you said, you go, okay, fine. Where in the world is there really good growth? Your example is Asia, China. Okay, cool. Let's have a look at that. Then it's okay. Now we're there. Now what is an industry inside Asia where there's also really good growth? And that's used the insurance example. And inside there, what are the good companies? Which are the companies that are best positioned and got great management teams, et cetera, and got good numbers that then can actually really take advantage of those two other kind of secular trends. And that's your kind of potentially your AIA example. Am I kind of getting that right?
You are almost, I think. Yeah. Like with investments, no, it's a very good way, but you described exactly what I said. But what I realized is I didn't explain it exactly the way it really goes down in that. And that's why these things are cool, because if you phrase it the way you think, I can kind of. So we go at it both ways. We go at it from the big theme. So we build two ways. I actually think we go at it more from the theme perspective, and then we find the country afterwards, interestingly enough. We're looking at secular growth themes, and we say, okay, the internet is a great theme to play. Where is the opportunity in the growth countries? So we use another one. Okay, a nice trend for us is the aging population in the US. So the US, the kind of I forget the name, the bump of the aging group. It slips my mind right now, but the baby boomers.
You like the baby boomers, yeah, like the
are shifting into the age profile right now, and the amount of over 65s is going to grow very, very fast right now in the US. So we'd say that's a great trend. What do we do about it? Okay, great. We can find well-managed pharma companies. They have another attribute that's great, isn't that they're not linked to the global growth. So if we're worried about the world and where the world's going, if we can lock onto a secular trend, which we think is aging population, and then we can find companies that actually don't depend on an economic cycle, that's a great trend to hook onto, Another one would be AIA, and this is quite important in this discussion. No, AR, secular trend, artificial intelligence.
Yeah.
Where we say, okay, this is a big growth area, and there's a lot of tech going in here. Be it robotics on the manufacturing side or the software side. So we say, okay, where do we find, we don't like to be on the bleeding edge of technology. Don't let that confuse you that we go out and buy Tesla and, try and guess who the winner is. We think that that's actually not the way to do it. The way to do it is actually to, as I guess we always talk about internally, sell the shovels to the miners. You don't want to own a miner, but you don't mind owning Hudeko that sells a bearing to a miner, right? And that's what we've done. We've gone out and found the guys that sell shovels to the AI or artificial intelligence community, which is a big thematic trend, but we don't know who's going to win. So we might as well go find the guy that sells the best laser that cuts robotically for whoever that winner is. So we know that we found the winner in a niche.
Because they sell that to, they're selling that to everyone.
Exactly. They are the dominant only laser cutting, and they got the best technology, and that's how we do it. So I think you can sometimes confuse us being trying to be on the bleeding edge of technology, but we're not. We're trying to lock onto a theme and sell shovels to them effectively.
Okay. And that's a good, again, I think for South Africa, the mining analogy is a good one, isn't it? Okay, cool. So a couple of questions have come through, but I'm gonna actually, I think let's ask them, because they'll be kind of very pertinent to what we're talking about. So first question is from David. If you look at the largest holdings in the S&P 500, they change far more often now than they did 20 to 40 years ago. Do you feel buy and hold forever days are gone? With tech and disruptive companies, doesn't that require high turnover of stock in a portfolio over, say, 5 to 10 years to generate alpha? So that seems like quite a good question.
Yeah, and that's an interesting question. I think it's like with everything, perspective. Everything seems faster now, and it is fast. I mean, the adoption of certain things has happened faster, but I mean, you've got to go look at the change in top tens and concentration has always fluctuated relatively fast. So yeah, sometimes it was oil, sometimes it was banks, sometimes so that point I think happens all the time in that changing technology. I think it's called the buggy whip, which kind of was like a story about how that kind of got taken out by the horse carriage. And, so when cars came through, was that a big technological advance that, took out a horse-drawn carriage, etc. So technological advance sometimes is always, when you see it in the current day, it always seems very fast, but it's been happening forever. That's all I'm going to say. So I think it's not something that's that new. For us, that's what I was saying, is that if you can lock onto these themes that have 10 years to run, we kind of don't have to guess that as much as the question comes. It's, if we own the S&P, I'd be very cautious because I'm locked onto so many things that I almost have no control over. But if I concentrate my portfolio into, as I said, JD, AIA, etc., it's a 10-year runway that we've focused on already. So we think that, doing that, but then watching the tea leaves and being flexible to change is probably the best way to do it.
So just give us the JD. I mean, JD, give us the example there. I mean, just more detail around JD. Yeah.
So JD is so we saw JD.com as a great way to play Asian e-commerce. Now, why we thought it was a great play is that they were building for the future. Alibaba was quite a third-party business, meaning, largely the whole logistics network is other people, right? So it's not their own guy that delivers to your door. It's a different guy. It's like an Uber guy. He has no connection to you. JD was investing in people, they owned the logistics. They built their own warehouses, and they were actually doing what Amazon did, I guess, in the US, but they were the number 2. So what they were doing was they were doing great things in an industry that was going to grow. They were going to set themselves up to be a really super number 2, and probably even take on Alibaba through time. So we knew not only did they position themselves in e-commerce, which was growing immensely in China, they were investing for the long term, which meant they could gain market share against Alibaba also, right? So it got to a point where in COVID, when COVID hit in China, Alibaba could not deliver anything because there was a regulation that third-party people just said, stuff it, I'm not going to deliver no matter how much you pay me. Whereas JD controlled that network and actually delivered all the healthcare that was needed in China. If you guys see the deliveries that were being made, they were being made by JD.com vehicles. And the Chinese government recognized and the Chinese people recognized that. And you've seen a big market share jump in JD over the last few years as a result of that. So the easiest way to do it is you can't know everything. That question of movement is absolutely important. You need to know the themes and trends for the next 5 to 10 years. I'm reading a book now on Honeywell. Honeywell is just a standard, company that supplies into the aircraft industry, supplies into all the kind of older type industries, right? But that management, and that'll fit into one of the themes that we were talking about, is this management recognized the change that was needed and started investing in tech and software within Honeywell to do automation for pilots, to build control rooms that were for the future, for an airport, for aircraft, So I think that's a big part of what we're going to get into. And one of the pillars is the management is a really great way to continue to direct the business to where the changes are. Now, if you're in a big commoditized business like oil, it's not that easy. You're trying to change your spots. And there are some of those guys like BP, Beyond Petroleum, talking about we'd be more cautious on a big sea change like that. But these incremental movements, finding these 10-year themes, finding managements that will move in those directions is an easier way for the buy and hold investor. But again, flexible. There are times that you sell.
I was about to say, again, something we spoke about yesterday is that you might have you might change your mind because the numbers and all the bits and pieces don't actually stack up anymore. So that flexibility is key. Which, but I also got a couple of other questions which I want to get to. So I do hope that answers David's question.
Is just to stop talking. So you just got to interrupt.
No, which I will. Don't worry. Okay. So then Anonymous, and as I said before, I do like people.
That's ominous.
No, exactly. I do like people giving their names, but don't stress. With the trends that you're referring to, it seems like SA is so far behind the rest of the world. Will we be able to compete and grow like the developed countries?
That's the great question, right? And it's amazing. I always say, depending on the share market or what's happened in the last 3 months, a lot of the time people will say to us, you're an Uber bear, Foord hates South Africa. We don't hate South Africa at all. We love South Africa. It's our home base. It's like everything for us. But the whole point is to be fact-based investors at the end of the day, right? Numbers and facts drive what we think. If you think about South Africa as a theme or a company, right? So China as a theme or company, the people are getting smarter. They're being paid $15,000 to $20,000 per capita. Americans are being paid $50,000 to $60,000 per capita, whatever the exact numbers. Through time, the one's going to trend to the other, which is a ginormous thematic trend. In South Africa, the problem is if you go look at all the standardized tests, we're not developing employable people. In the old days, demographics was the biggest dividend through time. Just population growth became, okay, South Africa aren't doing a great job, but at least the population's growing and, they'll buy more things. Gone are those days, like we don't have to, people don't get that benefit anymore. Right now, you get paid for intellectual property. So what worries us about South Africa is obviously the education thematically is a huge headwind for South Africa. As a company, we fund it very short term. If we talk about risks on a company, we do have long-term debt, but the problem is we're going to have rollover risk coming in after year 5. So we're spending more than we actually take in tax revenue by a long shot, and that's not COVID related. And everyone says, but our deficit's similar to a global deficit. The problem is in a ratio, if you've got a 10% deficit, not to get into the mechanics of it, you need your growth to be the similar number in order for your ratio to stay the same. So some of these developed markets have higher deficits, but they're growing. So the income is growing in line with the deficit to a certain extent. So thematically, South Africa is not appealing, but there are opportunities, right? As I said, the simple way to think about it is we own a stack of 186 bonds in South Africa, which is, in simple terms, a 5-year duration bond. It was being, over 9-10% we were getting offered to buy it a few months ago in this COVID crisis. We could lock in 10% on a 5-year bond, 9.5% on a 5-year bond. And we were going to get our principal back in year 5, obviously. So that was a great way to kind of take advantage of South Africa, even though we worried about things after year 10. And then we know that South Africa has lots of global stocks listed here, where you can also buy, which we could go into in some detail, some of the opportunities there. But it's our premise that given the global side, there's more opportunities there. Yeah. We're a smaller fish in a big pond, and that's why we got our full allocation overseas, because, we've got a team in Singapore. They, not South Africans that we've just supplanted there. They're global guys. One guy came from Temasek in Singapore. We've got Americans that came out of US varsity and been at US asset managers, and it's a real global team that we can draw on, right? So we're excited about that opportunity.
Yeah, interesting on that is that I recently did a course, and it was a piece of the course about diversity, and how diversity just gives you those different views and ideas and different perceptions on the same thing, and then that's how you actually generate ideas. So it sounds like you've pretty quite a
great point, right? So Dave, we'll have a discussion and say, why have we got so many CAs? They all think the same. Not really, but why would so we've got a geologist here, we've got a guy with LLB, we've got, I think Seth Klarman, who's a really interesting guy from Baupost, who writes letters that no one can get hold of, and a book that is no longer in print. And just if you want to learn about investments, try and get hold of Margin of Safety. But which is not our philosophy, but it's just a great way of understanding investments. So he was talking about the rower analogy of if you have, I actually don't know how many people are in an Olympic rowing team, but if you have all the same people in that Olympic rowing team that are big muscular guys, you don't win. You get one that's agile, you get one that's, different, and having different skill sets in that rowing team adds to the diversity and different perspectives that you need.
And that's in a sport where actually symmetry is key, which is very interesting. Yeah. Okay, I'm going to take ask two more questions, and then we're going to get back into the themes. I'm going to make sure we've got through 2, and then make sure we get through the other 3. No, it's all good. So Luanda, this is great discussion. So there we are. We're on the right track. On the theme of investing in secular trends, apart from economic growth, what are other macro factors come into play when looking at countries/companies?
Yeah, I think we're looking at everything. So what we do is we have a macro view that we actually put numbers to where we see the world going across all the key variables, And the way we see it is we're not going to be right. We're going to, if we, put a thought of where the oil price is going over the next 2 years, it doesn't mean we know that that's going to be the price, but it makes us apply our minds to those sorts of key variables. And, just using an example like that. So there's no one thing, but there are many things that are important. You need to isolate those ones that you think will be very relevant over the years. And I spoke about some of the themes, we just got to recognize those key themes. I could go into a lot more detail. I'm just cautious of time. Just using electric vehicles to work out whether platinum and oil are going to be dinosaur industries. That sort of thing is key. And, so recognizing the big thematic changes with, is modern monetary theory going to work? This whole new story, right? We have to have a view. We have to think about it. We have to have a thought of what's happening in debt. If debt in the country is exploding, what happens? Let's draw on the Japanese experience. So what we go to do is we investigate Japan. What happened when Japan pumped too much debt into a country, and what implications did that have? So there's no one answer to that, but it's understanding those key moments and understanding that it's probably happened somewhere in the world before. You better go and analyze that moment.
Again, using the car one, and again, so I think a lot of us are obviously very aware of the electric car coming to the fore. Something you mentioned again yesterday was that actually I think hydrogen cars, which I've never actually heard of before. I think
that's fuel cell. So they call it fuel cell cars.
Fuel cell, yeah, but that's actually renewable energy. So it's even better than an electric car in theory, I suppose. But they use platinum. So you've got platinum
No, sorry to interrupt you. No, it's a hell of an interesting space right now. The problem is no one really knows. It's like Betamax versus VHS, right? In the old days, not everyone will even know what that is. If you were to do a poll after this, no one will even know what Betamax was. That was, younger than me. Like, I'm just on the cut of what I know what Betamax is. Betamax, if you ask everyone, was a better technology than VHS. But adoption didn't take off, right? So in the psyche of people that just weren't adopted, it was a better technology. So to look out into the future and say, okay, the one's better than the other, it actually is not really important. Like, it is important, but it's where are the vehicle manufacturers spending the money? Because they're going to define where the world is, right? And I think electric cars have captured the spirit of people, and we think it will be the main one. But yeah, we're doing investigation on fuel cells because they do use platinum, as I was saying. And I think with renewables, the key use is you need to store that. So renewable, not to get into the science, but a renewable energy, you only get certain parts of the day, and you actually need it the whole day to make it a real, I guess, base load technology. So the future right now is going to be in batteries for renewables. So not only is it going to be fuel cells for cars, it's fuel cells for the storage of renewables. So that's an area that we are investigating. We just do think that the decline rate of the petrol car, for a simple way of explaining, is going to decline much faster than the adoption of hydrogen, which is probably a 5 to 10 year story. So it's important.
Okay. Yeah, that's so. Okay, the last, I said 2 questions. So quick answer this way, I think it's possible. So sometimes it takes a while for the theme to fully play out. How do you think about time frames in investing?
Yeah, so that's what Dave's book is called, Time in the Market, because you need time in the market to let these things play out. And our focus, as I said on the chat yesterday, is we're pretty good at the very short term, and we're pretty good at the very long term. We're not so good in the middle. But our biggest focus is on the long term and letting time.
Maybe it's intentional. I guess that's into theme. It's a pillar 3, which is short-term pain, long-term gain opportunities.
Yeah.
So that take us through that. Yeah.
Yeah. So it's another one. It fits in. So I think this world and the asset management industry in general has got really, it's momentum driven, short-term driven. It's about the next presentation to clients where they have to say they're in the coolest, best next thing. They get embarrassed about being different. They get embarrassed about being in a kind of stock that's going to have a really tough time for the next 12 to 18 months. And they just sell the thing and say, listen, we don't own that thing. Bidcorp, as a key example, being sort of supply into the restaurant industry. Restaurants are dead. Why you own Bidcorp? I'll come back in 18 months when things are better. So what we do is we see that as an advantage. We say, okay, let's assess this company. How are the management going to manage through time, having looked at the past? And then we go and assess the balance sheet. We assess the strength of the company. We say, okay, this company is positioned to be resilient through a really tough restaurant trade. They supply pretty much all the food and even to the serviettes and everything to the restaurant industry. And obviously their sales went from 100, that's baseline, down to 20% of what they used to sell. But the key there is understanding this is still an inherently great company with great assets, great management, and the terminal value or the value of a company is largely more than, it depends on the company, but 80% of the value sits like after year 3 anyway. So everyone gets really caught up in the first 18 months of a valuation, but actually the valuation's terminal, right? You buy a great company, well managed, and a good theme, you're going to get it back only after year 3, right? Whereas everyone spends their most time understanding 1, 2, and 3 years. So the reason that is because they're intending to sell it again. And that's the maths. They're buying something cheaply. And it's this, Warren Buffett talks about this transition. He used to be the cigar butt investing. What is a cigar butt investor? You have to have that last puff before it goes out. And then you throw it away and move on to another cigar. So there's a place for it, but it's not for us. Like we're not going to puff on the cheap, cheerful company that's not really in a good way over the long term.
So yeah,
that fits into this theme, is finding good companies that have sold off temporarily that inherently are good companies still. So another example that we chatted briefly about is Foschini. So Foschini won't be a company that you guys will have thought of as a inherently great company, but I would say inherently undiscovered, interesting thing that happened in that. So they were being sold off, but then what we knew, I guess, was coming was they were healing themselves with an underwriting for or a capital raise. So the management had previously taken it a bit too far, but then they were going to solve the whole balance sheet issue with a capital raise. So we weren't investors in Foschini before that. So we said, okay, let's analyze the business, and we bought a little bit of Foschini and we underwrote a bit of Foschini in the actual capital raise, having not been an investor. And then what happened was Jet became an opportunity. And we were probably the first guys to do the analysis of how game-changing Jet could be for Foschini. So everyone was seeing Foschini as it was, which actually we're doing so many good things internally, but everyone.
Who does Foschini own? Obviously Jet, the Markhams as well. I mean,
they did in the old days, a whole analysis to take off the S. That was many, many years ago.
Okay. Yeah. And that's
And then obviously Total Sports, and then they've got into retail in Australia and the UK. So they're also, So
they're bigger. Okay.
No, but I think that the key point there was actually it was very small in our lives, but then it was 40 Rand at the underwriting price, but we recognized that this Jet business could be 15 Rand of that, I guess, number, because it was just such a big opportunity, and they were buying Jet for below the inventory that they were actually buying in the Jet stores. And it became such a good deal that became the game changer, the optionality piece that got us interested in buying more Foschini. And the business has doubled in the last few months. It's just been a bit crazy.
And in an environment, I mean, again, where logic says you go to the shopping center and it's dead, and you go to see your retailers should be struggling, but because of Jet, I suppose the way it fits in the market is actually done. And it's as you say, it's done really well.
Correct. The result they just reported, and the result was awful, right? As you'd expect. Well, they put a trading statement last week, but we're not buying it for this year's trading. That's kind of this COVID kind of everyone's saying, how can you own it? You're going to sit in front of people saying you own Foschini. Are you sure? But and I had this chat with you. We can either be the intellectual champions of the world and sound erudite and tell you great things, or we can try and make you money. And I think we've always chosen the latter. Is the investor is important. Whatever I tell you today, and I said this to you, I think it's important. We are constantly testing our assumptions. So in that platinum example, we're very cautious of platinum. We don't own it. Who's to say we don't have a round table with some guy that's an expert on field sales and explains how important they are for the next 50 years, and we say, okay, no, platinum's a place to be. The last thing we want to do is have people stick and say, but Foord said. Foord said based on the information they have, but we are there to make money for our investor and make our investor retire better. You know, they aren't going to retire bets on me giving this great speech over the next hour.
Yeah, and then feeling you have to kind of stick to it, as you said.
Change, flexibility. Yeah. If there's one thing that we actually push ourselves constantly, is the word inertia. Inertia to not do something that needs to be done because of your holding period. So we always say we long horizon but flexible, which sounds inconsistent, but it's not. When you think, when things change, you better change. You know, don't stick with what you've done. And that was one of the questions. You know, this fast changing world. Well, we take a long-term view. We sit there if the story is the same, but if it's not, we've got to come together and change.
So the advisors and the investors do want consistency, but I suppose the consistency is consistency in your process and what you do,
and the not necessarily company. So we building blocks is, so we always think because risk is not volatility. Thanks, Mario. Just can you hear my voice is croaky, so it's just brought me another honey water.
I was going to say, maybe have a sip.
Yeah. So I think the key that advisors need to think about is our building blocks are, we come from a private client mentality. The whole thing is the building blocks are not relative. If I was trying to get to a point where I was trying to get to it, we're trying to, especially in a balanced fund or anything, we're trying to beat the bogey, which is inflation. Even in an equity fund, that mindset still persists. You know, we're trying to find the best certainty. We balance risk and return, and we're trying to achieve a benchmark, which is inflation beating results over the long term. And whenever we buy these companies, that's the mindset that we got to have. You know, like when we compare a 186 bond, which is 7, to a 2030 whatever bond, which is more than 10 years, that can get you 11. You know, we need to pick the one with the highest return given the risk, and that might be the 7 when you could have booked 11 per annum owning the 10-year bond. So mentality of us is building block is don't lose money for your client, beat inflation over time, have that mentality of an absolute return investor. Benchmark will be beaten if you do that correctly over time, and balance that risk and reward and the sensitivities and probabilities of being wrong. So that's kind of, so it is consistent, but that, and our holding period is longer than anyone else's. So, you know, we have over 5-year holding periods in most of our funds. So it does show that consistency. But all I'm saying is be flexible enough at the margin when you need to be. Largely consistent.
No, it makes, I think it makes sense. Absolutely. So I'm very conscious of time. So, and there are a couple more questions coming through, but we're going to get to kind of, so pillar number 4, which is all about kind of support perception management teams. So again, stewardship has often been talked about in investments. So again, I think management teams are key. So let's get into this one.
Yeah, I know, very quickly, and I'll use it as an example. Everything we do is management. Like, we think that, you know, management have a huge amount of value to add in time. And I use the simple example of Naspers. Naspers was an old stogie paper company. They took their cash flow, of course, went overseas. He did his MBA and he recognized that pay TV was the future and he invested in that. He then took that money from the pay TV business, invested it in many different things, one of them being Tencent, which became a huge win, and is now taking that money to invest in newer things. And that's the way I describe it simply is your client has given us money to manage as a fiduciary, like to manage on their behalf. Yeah. We then take that money and we give it to the next team that manages on their behalf. And just like we have to make good calls, good management can really make some bad calls, and trying to find those companies that risk manage for us, because sometimes we're going to have blind spots and we're not going to see it. But if the management team is on it and managing in that Honeywell example, you know, we might have thought we bought a plane company and we were wrong, but the team was so good that they actually did the risk management for us, you know. So those sorts of things are important, and that's management and the management.
How do you kind of, I mean, we've seen some stories, but how do you get around some of the PR spin? So management will come and say, listen, gee, things, and it's very much for the analysts and so like yourselves going, so you look at the numbers are okay. Maybe they're not okay. But the spin, the results, they've got a PR company that does it for them, and there's a PR spin saying things are rosy. How do you kind of see through all of that?
Yeah, I mean, that's why we hire analysts that we really believe in, and there's a lot of I guess kicking the tires to check that sort of thing. So one of the things we got, which I didn't mention, is we use an expert network to I guess corroborate all those things that we hear about, right? So there's more than one floating around, and we have access via an alliance with our global team to have unlimited calls with pretty much any expert around the world that we want. I know it sounds quite crazy, but some of the guys have it. So we can say, okay, Aspen says something about their French facility, right? Or something like that. So we can find someone that either used to work at the French facility or a competitor that competes with them in that facility and say, okay, talk about manufacturing. What does it cost to produce a valve? You know, and so trust but check, or whatever the words are, you know, the exact thing. And that network has been a huge help to us, in our opinion, to be able to do that. So the other point is facts. Deal with facts. In a morning meeting, a young analyst comes almost always, like if there's a young guy and says, the management said this. And then Dave will say, okay, did you hear what you said? The management said that. You didn't say it. They said it to you, right? And it's the words and the language is quite important in these things. It's like separate what they told you and what they did. And in doing that, that's the keys.
Yeah, that makes. That's.
I'm not going to say to you that we're going to avoid everything, because I think the key there is then, to use the analogy, Roger Federer didn't become the best tennis player in the world by hitting in the center of the tennis court every single time. He went for the corners, right? And sometimes the ball went out. And I think that's the key mentality of, you're not going to achieve your client's benchmark and beat the client's benchmark by hugging the benchmark. And in order to do that, sometimes you have to step away from your comfort zone to a certain extent, where there is a bit of risk of future outcome that might not be, right? Chinese regulation comes and says, okay, AIA are charging too much per person. You know, it happens. Like, you can't do that all the time. But being prepared, you need to be prepared to be different. You need to be prepared to be on that front foot, because that's actually, so using an example, on an optimist case, you can make 10 times your money. You can make 100 times your money. On the negative side, you can lose 100% of your money in a case. And it's understanding that the trade-off, that the optionality on the positive side, and an optimist, you know, generally wins over the long term.
Okay, cool. Okay, so then last theme, we pull it up. Manage the known unknowns.
Yeah, so that just revolves around our scenario planning. So we're trying to understand all these things, but as I said, modern monetary theory and things like that, we just don't know how it's going to work. Pumping this amount of debt, and I've got many theories on why it's happening and what's happening. We don't know. It's almost, it's like things will happen until people believe they won't happen anymore. That's how this debt burden is, right? You know, it's believable until people don't believe it anymore, and then it all falls down. That's how, I guess, these things are built. So there are many unknowns in the world. And one of the things we've always found is make sure you've got things that can deal with the unknown. And that's why gold ETF is actually been a very important, uncorrelated, diversified asset that can deal with these unknowns, because you need to find things that counteract portfolios in good and bad times. And it worked brilliantly in the COVID crisis. We probably did a lot of work on COVID and understood everything probably before everyone else. But the key there was understanding that having things in your portfolio to protect if we're wrong are going to be a huge compensator in that time. And that's why if you see our biggest outperformance, it's actually when markets fall. If you go look at all of our funds, the performance in the fall of COVID was immense, and we were so proud of it. The markets bounced substantially, and people have largely forgotten about it. But those are the things we need to do in this downside protection, understand where we can be wrong. And gold, and knowing that what you don't know is important, because then you know that you can't have 100% in one theme or in one theory. You've got to diversify, understand correlations, buy gold, ETF, not the miner. You know what I mean? So
yeah. That's exactly. It's about, again, you'll hold something because it's a great. The hold a different stock is a great diversifier for the rest of your portfolio. As an example,
we don't force it. So you don't say, okay, we need to own a telco in South Africa, so go find one. Like, the valuation still trumps everything, right? So we see gold as almost like a quasi cash, because cash has been, I guess, turned into trash by the governments of the world. The opportunity cost of owning gold is very low versus the upside opportunity of its protection. So we see it as a kind of opportunity cost. A lot of our things are opportunity cost. If we own more stock, therefore we can own less bond. If we own more cash, we can't own more bond. And opportunity cost in the theory, in the books, you build it up from your risk-free rate, and you put a premium, and you do all those things. At the end of the day, opportunity cost is where you can earn a better return on a risk-adjusted basis somewhere else.
Yeah. Okay. So we got 6 minutes left. I think there's one more question that's come through, which I'm going to ask, and then we'll probably wrap up. So this is from Martinez. What could you think would be the solution to fix SA Inc?
It's pretty simple. People just want confidence. Confidence that they're going to get their money back. Confidence that their hard-earned stuff aren't going to get taken away from them. And that comes with, in life and in everything, the job of a government and the job of a reserve bank anyway is to understand this animal spirits. And animal spirits and confidence allows people to invest for the future. So, I'm not going to mention all the things we know. It's just run a business or run a government that actually understands and cares to do the right things for that 10 years. So in that education example, don't worry that they are key voting bloc for the ANC. Worry more that they're delivering for your children to get a better life. Signal to a foreign investor that if they come here, we have mandated that we can't touch your money for the next 10 years. And you have a mandated return to invest in a railroad. The guys will come. The sovereign wealth managers are earning 1% in US dollars. That's 100 times PE. We have compelling opportunities for these people to come and bring their money here. They just don't want to bring it here if they're going to make 2 years of great money and then it gets taken away in year 3. So it's as simple as that.
Yeah.
It's not a lost cause. It's just simply that the signals are not great.
Yeah. And do you think they'll come through? We got the budget speak coming up on Thursday, I think it is. And is that going to, is Tito going to say anything which kind of goes, gee, okay, this sounds better, or is it going to be kind of the same perceived kind of story? I don't know.
I think there is a point that they're hitting where actually the money's, I guess, running out, right? So, which makes people, I guess, a bit more rational to do the things I spoke about, to get public-private partnerships, because there's no other way to do it right now, right? One of the biggest worries for us was this IMF money is going to make them complacent. We thought they were heading into that position probably, in this COVID crisis where they were going to have to be more responsible. But they managed to get a fair amount of money with no conditions attached to it to do what they wanted, which settled it a bit. So the flexibility is not that easy for a government whose deficit is over 10% to spend on infrastructure. So they need to do rational things. I don't know. I don't have a probability on it of them doing it, because it's not within their spirit to seek out these public-private partnerships. But I think we're getting to that point that they need to.
They're not going to have a choice. Yeah. Okay, then just last question for me. It's what I love to ask. Who's going to win the US election next week? And does it matter?
I think it's a vitally important question. I think. Yeah. So we're forward-looking guys. So I know it's easy to just say a name, but I think anyone and everyone in the industry, I never understand how people say they're not thinking about that, because there's a policy that's about to change. There's hundreds and hundreds of billions of dollars that's either going to go into renewables or it's not, and if Biden wins, that's going to be his big push. He's going to say renewable energies is the big target. Oil, he's already called for shale gas being almost cancelled, but he's not going to do that. So the last thing I'll say, so I think Biden will win. I'm not going to put my life on it, but I think Biden will win. But be careful what politicians say and then do. Yeah. So I think there's a lot of electioneering, and people say, okay, if it goes in Biden's case, there's going to be a certain taxes are going to go up hugely. He's going to do a lot of spending. America's actually quite, they sound a lot more aggressive than they actually are at the end of the day. So we think it's nuanced. We think Biden's going to win. We think it's going to be an acceleration of this renewable trend because of it. We think if Trump wins, it will be largely much of the same continuing. There are many implications that you've got to think about the China relationship. I think Nancy's going to do a podcast in the next few days and Brian, so one of our local analysts and one of our global portfolio managers are going to be talking about the implications for the US election in a podcast. So maybe we can send that to you afterwards.
Yeah.
So given the time, we're going to have a real detailed chat on that.
Cool. Great. Okay, our time is up. So Nick, I really do appreciate your time and the conversation. I think it's been really good. So thank you very, very much. So just also thanks to the audience for your time. As I said at the beginning, we really do appreciate it. I know there are lots of these webinars, and there's probably quite a bit of webinar fatigue, to be perfectly honest, and screen fatigue. So thank you very, very much. Just a reminder, CPD process. You should, if you attended most of the session, you'll get it in a thank you mailer. And otherwise, I think that's it from us. Thanks, Nick, and thank you all. Okay.
Thank you.
Cheers.
Thank you.
Cheers. Bye.